Today I'm going to talk a little bit about trading psychology and when not to trade. This is important because so often as traders, we are not spending enough time considering when we should be trading or when we should not be trading. And so today's video is going to talk a little bit about some of the times that you should avoid trading, because ultimately that can prevent you from losing a lot of money and ensure that when you are connected to the market, you're doing so in a way that stacks the probabilities in your favor for successful trading. So the first thing on this list is poor routine or preparation. Poor routine includes things like poor sleep, diet, health, social and family disruptions. These all lead to a lack of mental clarity. And this includes things like, did you have too much coffee? Does that lead to anxiety? Did you only sleep 2 or 3 hours because the kids kept you up all night? Or maybe you had a fight with your spouse or your boyfriend, your girlfriend, whatever it is, best friend, someone passed away. And mentally, that leads to you being in a very emotional or susceptible state for pain. So every day when you wake up and you get ready for your trading day, or when you leave the office, or whenever it is that you're finding time to trade, you need to do a mental check and be aware of your emotional state before you start to trade. Because when we trade, our connection to the market, it's through our minds. And if we're not in good emotional condition, we will struggle to control our emotions. And when you have a few losses and you're struggling to control your emotions, then that is going to more easily lead you to tilt. And then you cannot view the market through the right lens to even look at your edge correctly. So a lack of trading preparation, which is part of this poor routine and prep. It includes things like not charting or checking your data points like news, not looking at the volatility of the market, just jumping into the market, looking for movement, but not really watching anything carefully to see what is the market moving like. You can't just approach the market every single day like it's the same. The volatility of the market changes every single day. Lack of trading preparation also includes setting up your software carefully, not rushing into any of your screen setup and prep, because that can cause anxiety and poor decision making when you feel rushed. Another thing that affects traders is FOMO, or anxiety. These things are closely related. So FOMO stands for fear of missing out, and you need to be aware of this. Are you feeling anxious, or are you feeling the need to force or chase trades? Feeling fear of missing out or anxiety about making trades, typically it leads to chasing trades. And chasing trades is where you have poor entries and exits. It often leads to entering too late or too early, and it leads to abandoning your initial stop loss location and changing your trading plan on the fly a lot of times. Because when you enter late or you enter early, often that changes your risk reward and your stop loss. And now all of a sudden, your risk reward may be more poor than when you enter where you plan to enter or exit where you plan to exit. So being aware of whether you have a tendency towards FOMO right at the beginning of a session. I know a lot of traders that they trade the open and they always feel they need to make a trade in the first 5 minutes and they feel anxious about it. And when you don't address that, what ends up happening is that you end up taking trades even on days where you have no edge. So that FOMO, or anxiety to want to force trades and chase the market, it can be a really, really negative contributor to your trading regime every single day. Another state that you want to be very aware of and not trade when you're feeling it is called fear of losing. So many traders who are focused on a high win rate only instead of good risk to reward trading, they're often afraid of losing on a trade. And fear of losing causes traders to hesitate before almost all trades, and it affects your timing And that poor timing often leads to poor trade location again. And it also affects your perception of if you think a trade is even good. It gets traders focused on their win rates instead of profitability over the long run. Fear of losing also causes traders to cut winners short to avoid the dreaded, well, it went into profit, then stop me out type trade. This fear of losing typically leads to full-size losses and smaller winners, and that cuts into your profitability big time as a trader. And the reason fear of losing typically leads to full-size losses is because oftentimes traders, when the position goes against them, they'll keep their stop loss in place. But what they tend to do is on a trade that goes their way, they move the take profit closer if the market hesitates into their profit zone, which markets normally oscillate before they keep moving up. And so it's normal for pullbacks to occur. So what traders tend to do if they have a fear of losing is that they move their stop loss to break even or maybe even plus a few ticks. And what ends up happening is they get stopped out before they even give the trade time to actually develop and hit their profit target. And so it skews their risk to reward over the long haul significantly. And that's really negative. So you need to be aware if you have this tendency before you're trading that you're afraid to have a losing trade. Another reason to not trade is if you have extreme overconfidence or you feel like you're in God mode. And this is where, let's say after a nice winning streak, you're overconfident and you believe that almost every trade should be a winner. And I've been in this situation before where I have weeks of winning trades and I start to feel like I'm invincible. If you're starting to feel this way, you need to stop and check yourself because humble pie might be coming your way soon. If you feel this way, what typically happens is it leads to overtrading, and more specifically, it often leads to a trader breaking the cardinal rule of not adding to losers because traders have an unrealistic expectation of always winning. So you're thinking to yourself, I can just add to this position that's losing, move my stop loss, and I'll eventually win because, I'm a winner. And now you're changing your game plan as a trader and starting to abandon rules, and this almost always leads to the dreaded blow up or humongous loser. So winning's good, but you guys have to stay humble and recognize it's normal to have losses following a streak of winners, which can keep you grounded as a trader. And recognizing this is a natural phenomenon for traders, it can prevent you from having a huge blowout day, guys. So personally, some of my largest losses have come after weeks of consistent winning, where I developed God mode complex and became unaware of my own tilt due to prior winning streaks. Another thing you need to watch out for is when you are forcing your trading because you have a lack of availability to the market. So you lack time, and let's just say you haven't had much availability to the market all day long and you have an hour to trade. This is related a little bit to FOMO, right? Fear of missing out. Because when we lack time, we sit down to trade where we maybe only have an hour or two to actually trade. We feel the need to make it count. And it causes us to overtrade or feel like we may miss out if we don't make a trade during our availability to the market. This often leads to us trading setups that aren't part of our A++ list of setups. You guys have to realize that if you have a limited amount of time to trade and you're around a group of people who do have an edge during this time, you're probably going to be influenced to take trades outside of your predefined trading edge. And this can lead you to tilt when you lose because you aren't confident in the setup because of your own backtesting, but you're relying on others just by being around them because you're rushing to fit your trading into your schedule. So be aware of that. We should not force trades during our availability to the market. We need to let the setups come to us during the time. We have to watch the market, and this often leads to sitting on hands, which I think is the ultimate superpower. Sitting on hands basically means we're able to patiently wait for our setup, and it involves being aware of our mental state, which is affected by basically everything that I mentioned in this video, which is lack of routine and preparation, checking the FOMO and anxiety levels before you start trading, being aware of fear of losing, overconfidence, God mode, number 4, and number 5, lack of a time or having a limited availability and forcing trades, right? A lot of these things are interrelated, but I think if you can have a checklist where you can quickly run down, these are the things that you need to be supremely aware of. These are some really important ones that I personally spend time to focus on every day. I think if you can be aware of these things, you can really prevent yourself from trading when you're not in an optimal state to read the market. Back to sitting on hands, it ultimately involves being acutely aware of yourself and your tendencies to make poor decisions when you're not in the best mental state to trade. Unlike when driving a car and there's a sensor for alcohol, for example, for your breath, and that can prevent you from crashing your car. In futures, where we drive this ultimate F1 trading vehicle, it's an ultimate trading vehicle and dangerous because it involves high leverage and low margins. In futures, the only one that's going to prevent you from making poor decisions in your trading and trading under the influence of all these negative things that I've listed is you. So you need to be aware of all these negative things. So mastering your trading psychology is more important than mastering the technicals. Because if you can't control your mind and prevent yourself from all these bad habits, you'll end up blowing up your account or having a huge losing day that erases days or weeks of work. And the psychological effects can be devastating, forming bad habits that can last days, weeks, months, or even years. So the focus each day before you make trades is to be aware of all the positive and negative effects of various things that can impact your trading. You have to be self-aware and allow yourself to get back to a place of equilibrium. So there's a few ways to bring yourself back to a balanced emotional state. That's equilibrium, emotional zen, if you will, being completely at peace. So number 1, step away. If you can't work through the problem, well, in real time, being near the market will likely cause you to be tempted to continue trading. Number 2, get some exercise. That clears out the hormones, which can help with mental shifts, because when you are in a negative emotional state, lots of bad hormones are released in the body, and a way to clear them out is through exercise. Number 3, talk it out with your trading buddies. Have accountability partners. Make sure you're surrounding yourself with people who actually encourage you to do the right thing. You guys need to recognize growth like this is normal, and just like building new muscles is painful, and overcoming bad habits outside of trading is difficult. It is also difficult to overcome your trading psychology, but it is super, super necessary to improvement. I also think you guys should be journaling, and don't be afraid of connecting with others publicly who are on the same journey as you. I think it's really exciting to be aware of all these potential roadblocks, guys. I mean, this is an amazing opportunity for you guys to be aware of all the things that are preventing you from being in the right frame of mind to make the best decisions as you trade. And that ultimately leads to better trading. So happy trading, and don't be afraid to talk about it with me or anybody else.